So let's look at why does it work and who uses it. And I truly believe that understanding price action is a foundation forever. It's an auction process with supply demand that you can apply in the markets as a strategy forever. Now, will you kind of use this as a set in stone strategy for all of time? Maybe, it's possible, but the way that you look at things will mean that as you progress as a trader, as you start to move forward, you can say, you know what, I'm going to add this strategy into it. I'm going to add this setup into it. I'm going to look at the markets in a different way because the markets will change. We'll have new markets out there. We'll have new kind of trading environments, new challenges, new opportunities as traders, which is great. But having that core foundation of understanding supply and demand and price action means that you can then add more things in as they come along. We're not just talking about one setup here and these are the rules and that's that, because that's handy, but it's not going to keep me forever, is it? It's always going to change. I know over my 15-year career, or 17 years now career, it's changed dramatically. The setups I've used have changed. So one thing that worked very, very well in one period of time kind of doesn't work at all in another period of time. But understanding how that changes and how you can be flexible is where the value is. Okay guys, so now I want to talk a little bit about the trader's goal, because it's all very well we kind of sit here and we talk together about price action strategies or how we should look at the market, but again, let's strip everything back and let's think. Ray Dalio once said, Ray Dalio, you know, famous kind of manager of Bridgewater, he said, in trading you've got to be both defensive and aggressive at the same time, and that's the dichotomy of trading. And really we're kind of trying to preserve capital. We're trying to, you know, make sure we don't lose money. We're risk managers at the end of the day, want to keep the money we've got. If we haven't got any money to trade, we haven't got a tool to use, because ultimately capital is a tool that we use. We don't have that, we don't have any tools. But also we want to accumulate capital. We're not doing this just for fun. We're not kind of playing around and messing around here. We want to make, you know, as much money as we can. And so we've got this dichotomy, this kind of decision-making process where we're like, okay, I need to make money, or I'd like to make money, that's my goal, but I also want to be very cautious about how I'm deploying capital, which comes perfectly to this. I believe our goal as traders is to make as much money as possible with as little risk as possible. So let me explain what I mean by that, because you know, we want as traders obviously to accumulate as much as possible in our trading accounts. That's why we're trading, right? You and I, at whatever level we're at, are all trying to accumulate profits in our trading account. But at the same time, we want to risk as little as possible. So that's our overall goal, I think, for most people in the markets. And so if that's the case, then why don't we take that through for each one of our trading decisions? So each of our trading decisions should have that underlying theme of, does it align with our overall goal, which is I want to make as much money as possible, the least risk as possible. If it aligns with that goal, then we take the trade. If it doesn't align with that goal, then we don't take the trade. The beauty of thinking of it like this is that we say to ourselves, yes, we know we've got to protect our capital, but we also know we've got to put some of the chips in the table at some time in order to make more money. We've got to put money down, we've got to put bets on, we've got to put trades on, we've got to put capital at risk, otherwise we're never going to accumulate the capital we want to accumulate. So understanding that our goal is to make as much money as possible with as little risk as possible. And if that kind of resonates with you, then we're on to a winner. Now, if we look at the trader's choice, so we think about how trading can be packaged, if you like, and how setups can be packaged. We've kind of got two ways of looking at it. We've got a risk-reward ratio, which is if, let's say, we had a 100-to-1 risk-reward ratio, or 1 to 100, however way you want to package it. In other words, we're risking, say, £1 to make 100, or 1,000 to make 100 grand. Now that sounds really good, right? Really good. And if we could do that all the time, we'd be happy. But then, generally speaking, the higher we go on the risk-reward ratio, i.e. if we go from kind of 10 to 1 to 100 to 1 to 1,000 to 1, let's say we're to 1,000 to 1, what's the chance of that trade actually being a winner? In other words, what's the chance of us hitting that 1,000? Generally speaking, the probability of success of that trade goes down. So it's inversely proportional. Right? If we want a really high risk reward ratio, we've got to accept the fact that really, the probability of success of that is going to be quite low. If we're looking for 100 to 1 on our trade, we're not going to hit that 50% of the time. Right? So it's inversely proportional. Whereas if we start to go the other way and we go, okay, well, actually, I don't want to kind of hit 50% of the time. I want to hit my trades 90% of the time. We're unlikely going to be able to get a decent risk reward ratio on that. We might even have to take a negative risk reward ratio. We might have to risk 1 to make kind of a quarter, that kind of thing. So you can see how this is inversely proportional. As we increase the probability of success, in other words, the probability of the trade being profitable, then the risk reward ratio goes lower, and as we increase the risk reward ratio, the probability of success goes lower. So as traders, and actually before we kind of move on to that, if you think about the casino, I talk a lot about the casino because it makes perfect sense to many people. There's a fixed odds in the game and there's a fixed risk reward ratio in the game. In other words, it's a fixed payouts. So not knowing off the top of my head what the payouts are exactly, but you perhaps got a roulette wheel and you spin the wheel and there's a fixed payout for red or black, which is just under, or kind of, I think it's, you get your money back, basically get double your money back, right? So it's double the money, but the actual probability of success is slightly less than half. So you can see that over time the casino will win because they've got it skewed slightly in their favor. In other words, yes, they are paying out money and they've got that risk reward ratio to them of almost negative, isn't it? Because they're risking 10 and they have to pay out 20 on that particular bet. But they know that over time, the majority, if there's enough spins, they know they're going to make money because the probability of that coming in is slightly better for them than it is for you. And so you can think of that of anything, like if you're betting on a number between 1 and 100 and the payouts have obviously got a 1 in 100 chance of coming up if it's kind of an even win, everything's fair as it should be. But in reality, so the payout should be 100 to 1, right? Because that's the odds of success. But if the payout becomes kind of 50 to 1, that's not a good deal for you. It's a good deal for the casino. If the payout becomes 200 to 1 and you've got 100 to 1 odds, that's great because you play that all day, every day. And so thinking like that in terms of trading, we want both risk reward ratio high and, if possible, probability of success high. I'm not really happy with taking something that is this way. There are trades out there, guys, where we want a high probability of success. This is why we use price action trading and a decent risk reward ratio. So we ultimately, when we're picking a trade, this is why entry is so important as well. And not to kind of get ahead of myself here, but why we don't just dive into trades, because we might see something going up and might see, that trade's, the market's going high, the price action dictating that, the strategy looks like it's right, the setup looks like it's right, and we might kind of pile into it, but then the risk reward ratio is skewed because it might be sitting through a big drawdown. Yes, the direction might be right, but it might be sitting through a big drawdown. So timing the trade, picking the trade and timing the trade, we're going to talk about filters and triggers later on, but picking it and timing it means that we're trying to fine tune both of those dials. The risk reward ratio, want a decent risk reward ratio, want to be paid well for the risk we're putting on, and we want a high probability of success. If we can get those both high, now an ideal world would have 95% probability of success and 100 to 1 risk reward ratio. Yes, that would be lovely, wouldn't it? Because we play that all day, every day with maximum position size. But some point between that and kind of even is where we want to be. So if we just briefly look before we kind of move on about the option sellers versus the Black Swan fund. So for those of you not aware, Black Swan fund is basically someone who's a fund who bets on extreme events. So they will do things like they will buy far out of the money put options on the S&P 500, the S&P 500, or they'll buy far out of the money call options on VIX, which is the volatility index. So in other words, they are bets on extreme events happening. So there will be all sorts of things. They'll do that in bonds, they'll do it in currency. So unusual events. So as you can imagine, the probability of those bets or those trades paying off, it's pretty slim, right? You don't get crashes in the market every year. You go through multiple kind of quarters and nothing happens, and even kind of little blips aren't really crashes. So they're not getting paid out regularly, but the risk reward ratio they're getting is very, very high. So they're getting paid out multiple hundreds to 1,000 to one, perhaps even more. I'm not even sure myself what the risk reward ratio is, but the point is these guys are playing at the one end of the scale. On one end of the scale is, hey, they're prepared to be wrong multiple times, but when they are right, they're making a lot of money, which if they structure it correctly makes up for all the times they're wrong and makes them a profit. So they're one end of the scale. Now if we look at the other end of the scale, which is option sellers, so specific type of option seller will sell also almost the other side of that black swan trade. Okay, they'll be the sellers, the counterparties to that trade, and be selling out of the money call options, and most of the time when you're selling something, a call option that's out of the money, it'll expire worthless, and so they will collect the premium for that contract. So they're basically collecting money, almost like selling insurance, perhaps you can look at it like that. And so as you can imagine, their probability of success is very, very high. Okay, they're making money regularly. The risk reward ratio is quite dangerous because when they're wrong and they have to pay out, they probably have to pay out multiple times, like 100 times, 200 times the money that they put at risk. So there's two ends of the scale for you. And as our type of traders, or swing traders, day traders, we want to find a happy medium between the two. We want that high payout and we want a decent probability of success as well. So if we can get the best of both worlds, which we can with the right setups, the right strategies, the right filters, the right processes, yes, we're not going to come across them every day, not going to come across them all the time, but when they're there, then we have the opportunity to do what we're trying to do with the trader's goal, which is to risk as little as possible, the risk reward ratio, and make as much money as possible by doing so.